Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 176 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in our long-term financial journeys. It is Financial Literacy Month. April is Financial Literacy Month. And so I want to help you guys with some specific topics, some specific terms and ideas that I think can be helpful for you in better understanding the financial world and better understanding what is going on in your own personal financial life, and maybe just bring a little more clarity to your finances in general. And so today we are going to be talking about bull markets and bear markets, right? Because these are terms that I'm sure everybody has heard of, but very few people actually understand what they mean and understand what the implications of such terms are for your investing life and your financial life in general. So we're going to dig into those terms and exactly what those have looked like over the long term in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, if you are an investor, or even if you are not, right, it's very likely that you've heard the terms bull market and bear market, right? And it's very likely that you maybe tune out as soon as you hear such boring lingo as bull markets and bear markets and ups and downs of the stock market and all these different types of things, right? It's not very interesting. It doesn't seem very interesting. Now, if you are an investor, it seems a little more interesting, but at the same time, I think a lot of investors don't even understand what these terms mean. And I think it's very important to understand what the terms mean and not be so fearful of bear markets and really enjoy bull markets a lot more. And I think the statistics help us to bear that out, and understanding what these different terms mean, bear this out. Because what the layman is going to hear the most often is about bear markets and the scare of bear markets and all these different types of things, right? They may hear about a bull market, but they may not hear about it in a positive light. Right? So I think it's really important to shed a positive light on bull markets and to be a little less skeptical of their origins and of how long they're going to run. And I think it's very important to also understand that bear markets are not all that we believe they are, but they have a very specific place in our financial system and in an investor's life over the long term. And so let's just start with some basic definitions of what a bull market and a bear market are. And we will start with the bull market. A bull market is a market that is on the rise and where the conditions of the economy are generally favorable. Okay. Now, bull markets can also be described as a market from the lowest close reached after the market has fallen 20% or more. So the market falls 20% or more, and from the lowest close to the next market high, that would be considered a bull market period. So basically you fall 20% or more, then from that lowest close, once you get above the previous highs, then it is considered a bull market, and then it'll go on for however long the market continues in that upward trajectory. So that is the basic idea of a bull market. Now, a bear market exists in an economy that is receding and where most stocks are declining in value, right? Now, that is a very vague description of what a bear market is, but more specifically, when an index like the S&P 500 closes at least 20% down from its previous high, right, through the lowest close reached after it has fallen 20% or more, that is considered a bear market. So it's from the previous high all the way to the lowest low, right? If it has fallen 20% or more, that is considered a bear market, okay? And so those are our basic definitions. Now, because the financial markets are greatly influenced by investor attitudes, these terms also denote how investors feel, okay? And I think this is a danger in what we have going in financial markets, is that we base the idea of a bull market or a bear market on how we feel about the market. Are you bullish or are you bearish, right? Bullish meaning, are you really hot on the market? You like what's going on. You want to buy, or are you bearish, right? Do you not like what's going on? Do you want to sell? Is sentiment bad, right? So this idea of feeling around bull market and bear market, I think really gives us the wrong idea, because these bull markets and bear markets actually have more common definitions, like we just went through, that will allow us to better understand what they are, and they have some statistical backing, right? It's based on the price movement. It's based on either the height of the market after a low, after the market has fallen over 20%, or the market falling over 20%, and that being our bear market idea. Now, a bull market is typically looked at as a market that has a sustained increase in prices. So in the case of equity markets, a bull market denotes a rise in prices of company shares. In such times, investors have faith that the uptrend will continue over the long term. In this scenario, the country's economy is typically strong and employment levels are high. So until the coronavirus crash, right, until March of last year, when the market took a nosedive, over a third of value was lost in the S&P 500, the market was on the longest sustained bull market that we have ever had. Okay, so the market was going up in a pretty straight line from the financial crisis to the coronavirus crash. And ever since the coronavirus crash, we are well above those old highs, and we're meeting new highs now as well. So we are in a new bull market, and no telling how long this will last. But that's not my place to determine how long they'll last. It's just my place to tell you exactly what they are and the recent history of what they've looked like. Now, in contrast, a bear market is one that is in a decline. A market is usually not considered a true bear unless it's fallen 20% or more, like we discussed. Now, in a bear market, shares are continuously dropping. This results in a downward trend, and investors believe will continue. This belief, in turn, perpetuates the downward spiral. During a bear market, the economy slows and unemployment rises as companies begin laying off workers. So the bear market, right, the downward pressure on stock prices is driven by the underlying economy. So the bear market that we reached during the beginning of the coronavirus pandemic had a lot to do with the fact that the coronavirus pandemic was occurring, right? It didn't have to do with a weak financial system necessarily. It didn't have to do with the fact that things were not good economically leading into the coronavirus pandemic, but because when the economy shuts down, then a lot of companies are going to hurt, and the country as a whole is going to hurt. Unemployment is going to rise, a recession occurs, they're laying off workers, all these different types of things. And so when that happens, you're typically going to see a bear market occur. Now, it's very important to distinguish with a bear market, and this is why I said I think we have the wrong idea in a lot of cases. A bear market is not just when the market's going down quite a bit, right? So we have this term, a correction, where that's typically an index falling 10% in value, between 10 and 20% in value. That is considered a quote-unquote correction. Okay, so this kind of gives us the idea that something has kind of course corrected downward, but maybe has not fallen into that bear market territory. Okay, and so just because something has fallen doesn't mean that it has to be in a bear market territory. It could be just in a correction territory. It could have just corrected. Now, a lot of stocks do this very commonly, right? We've seen even in the past few months, stock like Tesla's fell over a third in value, right? It went from over $900 a share down to below $600 a share. Okay, so it by itself was in bear market territory. But typically when we're talking about bull markets and bear markets, we are talking about the market as a whole. We are not talking about specific stocks. We are talking about the indexes. But you will hear, if you watch CNBC or different shows about investing or different podcasts you listen to about investing or whatever it may be, then you are going to hear, this stock is in bear territory. All that means really is that it has dropped more than 20% if they're using the term correctly. So make sure that you're just not taking somebody at their word when they say in bear territory or bear market or whatever. Actually look at the prices and understand exactly what they're talking about. Now, what are some characteristics of bear markets and bull markets? So Although a bull market or a bear market is marked by the direction of stock prices, there are some accompanying characteristics that investors should be aware of. So, in a bull market, there is strong demand and weak supply of securities, right? So in a bull market, people want to buy, strong demand and yet weak supply, right? There's not as much coming into the market as there is being bought up. In other words, many investors wish to buy securities, but few are willing to sell them. As a result, share prices will rise as investors compete to obtain available equity, right? As more investors are buying up shares and wanting to keep them and not sell them, then the price of those things go up. That's just natural economics, right? And then in a bear market, the opposite is true. More people are looking to sell than buy, and the demand is significantly lower than supply. And as a result, share prices will subsequently drop. Now, a lot also goes on when it comes to investor psychology in bear and bull markets. So because the market's behavior is impacted and determined by how individuals perceive and react to its behavior, investor psychology and sentiment affect whether the market will rise or fall. So stock market performance and investor psychology are mutually dependent, right? The market, what the market does, depends on what investors do, what investors feel, how they are thinking about stocks, or how they're thinking about the economy, or how they're thinking about different things that are going to impact stock prices, okay? So in a bull market, investors willingly participate in the hope of obtaining a profit. So investors want to be a part of the market during a bull market. They believe that they can make money. They feel good about what's going on. Their mental state is very positive, and they jump into the market. But during a bear market, market sentiment is negative, and investors begin to move their money out of equities into fixed income securities like bonds, or they move it maybe even into cash, and they wait for a positive move in the stock market. Now, let me just tell you, this is not the proper way to do it. If you're watching this and wanting to learn more about bears and bull markets, right? Just because a bear market is occurring doesn't mean you need to jump out. So you can't just jump out of the market when things are going downward. Now, you may be like, well, why not? Isn't that a good idea? No, because most people who try to do that end up losing money on the other end, right? They end up missing out on gains that they could have made if they would have just stuck it out. And we'll talk a bit more here in a short period of time how you can actually stay in the market and still make great sums of money, and why the bear markets are relatively short compared to the bull markets. But this causes investors to keep their money out of the market, okay, which in turn causes a general price decline, right? As money is kept out of the market and there is more supply of securities than there is the demand for securities, then the price of stocks and the price of other securities may go down in value, okay? So investor psychology really drives markets, and it drives specifically whether or not we are in a bear or a bull market. Because even if things are good relatively, if investors in a broad sense think that things are going to go bad, then they can push the market down as far as they want to. I mean, we've even seen how investors can drive stocks up as much as they want to. We saw in the whole GameStop fiasco that as people buy for no good reason, they can shoot a stock to the moon, right? And we've seen with something like Bitcoin that as people buy, you can shoot it to the moon, whether or not it is as valuable as the price says that it is. Who knows? But investor psychology, investor sentiment drives a lot in stock prices. And then economic activity also has a big impact on bear and bull markets, because the businesses whose stocks are trading on the exchanges are participants in the greater economy. The stock market and the economy are strongly linked, okay? Now, given that the stock market and the economy are broadly linked, it's important for me to note that especially during the coronavirus pandemic, we have seen the fact that even though a lot of companies have struggled and a lot of small businesses have struggled, a lot of large companies have thrived. And so the stock market indexes have gone up precipitously since the bear market of last March and into April. So they've gone up quite a bit in the way of price. And that is a decoupling of the market and the economy quite a bit, because the economy as a whole wasn't doing very good because unemployment's been high. Small businesses aren't doing well, but a lot of the larger companies could continue their operations in the way that they wanted to do so. Okay, so a bear market is associated with a weak economy. Most businesses are unable to record huge profits because the consumers are not spending nearly enough. We saw this during the coronavirus pandemic in quite a strong way because the savings rate in the United States really spiked during the coronavirus pandemic because people were afraid of what was going on. They were keeping more money at home, spending less into the economy, and therefore having a negative impact on the profits of many, many firms. Okay. In a bull market, though, the reverse occurs. People have more money to spend and are willing to spend it. This drives and strengthens the economy. So as people have money in their pockets, they can spend that money and allow the stock market to continue upward and the prices to continue upward. And this can be seen in, the Trump presidency. You saw how there were tax cuts, and the tax cuts allow for there to be more money in the pockets of both individuals and companies, which allows for more spending, more reinvestment, and it allows bull markets to continue upward. Now, what exactly have bull markets looked like in the past, and what exactly have bear markets looked like in the past? I think that's a very important question to answer, because if we don't know what they look like and we don't know how to spot them, then it's going to be difficult for us to know how to win or profit based on what exactly these different types of markets look like, okay? So if you look at the statistics, okay, since 1942, so we are looking at this point, nearly 80 years of data, okay? But if you look since 1942, daily stock returns of the S&P 500 index, okay, and you look at bear market periods, okay, so let's start with the bad and then follow it up with the good. Bear markets have lasted on average 11.3 months with an average cumulative loss of 32.1%. Okay, so the average cumulative loss, meaning the total loss, really, I don't want to call it a loss because we're not necessarily cashing in on the loss, right? You only lose money if you sell. Okay, but if you look at the average drawdown, the average cumulative drawdown of the stock market, it was 32.1% and lasted only 11.3 months. So bear markets last less than a year on average. So that means to go down over 20% and then make it back to the point at which the stocks were at their high, they last on average 11.3 months. Now, how does that compare with bull markets? Well, bull market periods on average last 4.4 years. Okay, so 11.3 months for bear markets, but 4.4 years for bull markets. Okay, with an average cumulative total return of 152.6%, compared with the negative 32.1% cumulative loss of a bear market. Okay, so you tell me, why would you not want to be invested in the stock market? Okay, if the if the positive times are going to be over 4 times as long as the negative times, and the gains of the positive times are going to be over 5 times as large as the losses of the negative times. Okay, this is one of the biggest arguments for being invested in the stock market over the long term, because people are so scared of the bear markets, and the bear markets get so much in the way of attention from the market. They get so much attention because people are like, oh, it's so bad. Things are horrible. We've lost 30-something%. The economy stinks. Unemployment's high. All these different types of things, which can be true, right? I'm not saying these things are not true. I'm just saying that it is irrational that we look at these things with so much negativity and not look at the upside. We're pessimistic people as a country. We're pessimistic people. Typically as investors, we are quite pessimistic. But to take an optimistic view, just look at bull markets. You don't hear every day on the news that, oh, the stock market has gone up 2% today, or it's up 70% since the bottom of the coronavirus pandemic. You don't hear that, right? But during the coronavirus pandemic, when it first began, during that crash, right, all you were hearing every day was, oh, stocks are down 5%, stocks are down 4%, stocks are down, everything's horrible. There was red on every screen. It was on 24/7. It was on at night when it's not typically on CNBC, right? All the investing shows, because everybody was just so darn stressed out about what was going on with their money. But why aren't these things occurring when things are good? Because things being good last so much longer, and it's so much more pronounced than the bad. Now, the longest bull market that we have had has been 12.3 years, and that's based on the definition that I've given to you previously. But that bull market was from the late 80s into the 90s before the dot-com crash at the end of the 90s, right? But many will say, they will argue that the bull market of the 2010s, from the great recession all the way up until the coronavirus crash, was the longest actual bull market that we've had as an economy, because a part of that one bull market during the 90s was a recession, right? And so people say that even though there was a bull market as far as the definition that I gave, that doesn't necessarily mean that everything was going well. And so they kind of discount that back to the recession, which makes the most recent bull market the longest. Now, from that bear market in the late 80s all the way to the late 90s, that bull market that they identify there is 582.1% cumulative gain. Could you imagine if you would have sold out in the late 80s, right, during Black Monday in 1987 and all those different types of things where things were just, oh, it's so horrible, the worst one day in stock market history. If you would have just sold out and stayed out for the next 10 years, you would have lost some of the best gains that there have ever been in the stock market. Okay, and the average annual return then was 16.9% annually, which is just a fantastic average annual return. Then the most recent bull market lasted about 11 years and had a 400.5% cumulative gain, and the average annual return was 15.8%. Which is, again, absolutely awesome. That's an awesome average annual return. But if you really want to know how crazy it is to think that bear markets are so horrible relative to bull markets, you can look at the most recent bear market. The most recent bear market lasted 1.1 months, okay, by the definition that I've given here. And the depth of it, the loss of that bear market, was 33.9%. Okay, you would just come off a period where you could have made 400.5%, and you just lose 33.9% of that. Well, guess what? Since then, the 9 or so months since that drawdown, or 10 months since that drawdown that is given here, we're missing just a couple months of current data. And what I'm using is statistics from First Trust, really good things. You can look up First Trust bulls and bears and get this same printout that I'm looking at here. The upside since that bear market, right, in that 9.3 months following that bear market, was 67.9%. So who cares if you lost 33% in your investment value? You've made over 60% since then, right? You've made nearly 70% since then, okay? So it is irrational to think that bear markets are so horrible and bull markets are just all right. No, bull markets are amazing relative to bear markets, okay? Bear markets hurt for a short period of time, but bull markets are sustained upside, and they are the reason that we invest, right? If you are not overall bullish about stocks over the long term, then you haven't done enough research. You haven't looked into your history books enough. One book that I would recommend that talks about this, and I've talked about it before here on this show, is Stocks for the Long Run by Jeremy Siegel, right? That book is fantastic and tells you everything you want to know about long run stock returns and tells you why you should be invested in stocks over the long run. But this is a great example, right? These bull markets relative to the bear markets. If you looked at this sheet that I'm looking at here, the bull markets are these long, huge, expansive graphs that look really big and powerful. And then the bear markets are just blips, right? They are blips on the radar. And when it all comes down to it, they are blips on the radar. Look at the S&P 500 chart. Go to Google and just type in S&P 500 and go to the max, right? The maximum amount of time you can look at the S&P 500. And just look at that chart. You will barely be able to recognize the bear markets that we've had. Yes, the most recent one you will be able to see, and you'll probably be able to see a little bit from the Great Recession and the dot-com bubble, but they won't be the gouges that you think they are, right? For the most part, that graph moves up and to the right, which means that stocks are going up in value over the long term. And that's exactly what we want to know. What we want to know is, even though bear markets and bull markets are occurring, we should not be so afraid of the bears. Right? Ride the bulls. Don't be afraid of the bears. And when bear markets do occur, guess what? You have an opportunity. Okay? When you hear people talking about it being a bear market, talking about things being down and being all bad, right? All you have to do is do some research for yourself and see if now is a good time to buy. That is not a good time to sell typically it is a good time to buy. I've told you guys this before, and I'll reiterate it now. At the bottom of the coronavirus crash, my wife and I put in a substantial amount of money into the S&P 500 and have made that 70% upside from the bottom because we recognize a bear market when it occurs, and you can profit, even in the short term, you can profit from the bear market. But buying at such low prices will allow that money to grow and have a higher average annual return than just about any other monies that you'll put into the market over time. And so that is a good time to be putting in more money. And, some people say, well, bear markets, wouldn't they be good times to take some money off? Well, good luck trying to do that. If you're trying to take some money off during bull markets, you don't know how long the bull's going to run. Okay, but you can historically look at bear markets and go, I know how far the market has fallen in the past. I know how far it is likely to fall if it does in the future. And look and see, I noticed that most bear markets, right, are extremely short. And if the market fell more than 30%, it is undoubtedly a buying opportunity. And so the market fell more than 30%, and I jumped on the opportunity to buy more and buy more in a big way. And so we just need to be aware of this, right? The reason that I'm talking about this first when it comes to your financial literacy is because these are buzzwords that you hear. These are words that you've probably heard for a long time, and you may not have had any clue of what they meant. Right? You may not know what a bull market means or if it should mean anything to you. Okay. Overall, these words, it's just semantics, right? It's just words that we use that mean something. But overall, what I wanted to convey here is the fact that you should be investing. Okay. When you are financially literate, right? If you want to be financially literate, something you have to understand is that the value of assets like stocks goes up over time. And if you're just holding cash, right, then the value of your cash is going down over time. Inflation eats away at the value of your cash, right? But the stock market grows higher than the rate of inflation over time, therefore increasing the value of your money. And it does so in huge amounts relative to when the stock market goes down. So if you buy a broad diversified index like the S&P 500 and just keep putting money in systematically over time, you can make huge gains, and you can win if you keep money in even during bear markets and invest all the way through bull markets and allow yourself to just remain invested. Some of the most successful investors of all time remain invested. Yes, they make changes to their allocations. Yes, they change what they're invested in maybe from time to time, but they remain invested at all time because they know that the bad doesn't last very long and the good times can last for a long, long time. Like I said, the good times can last 11, 12 years. But, like I said, on average, 4.4 years. And what's interesting about that 4.4 years is that's really brought down by a few bull markets that were 2, 3, 4 years back in the 50s and 60s. But since then, we've seen 6.2 years, 5 years, 12.3 years, 5 years, 11 years, right? And we're, almost a year into the beginning of another bull. So we'll see how long this one lasts, but hopefully you can take advantage of it. And don't be afraid to take advantage of bear markets. Just don't let the bear scare you and don't jump out at exactly the wrong time. Understand that market weakness is not going to last forever. And if it does, then we're all going down with you. So if you just follow history, you understand what history says about the stock market, then investing is far less scary, much less of a daunting task, and you can actually make a lot of money over the long term. So I implore you, right, in becoming more financially literate and learning more about your finances, that you really give investing a hard look, and you have to increase the value of what you have over the long term. Because if you want to live a life that is abundant as you get older, and you want to not struggle and not have to go into debt and not have to borrow money from people and institutions and not have to work until you're 80, right? Then you need to be putting money away and allowing the power of compound interest to grow for you, and allowing these bull markets to pull you up, and allowing the power of the stock market, the power of appreciating assets to increase the value of your money over time. That way you can live a financially free life. and eventually money can be no object for you and your family. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video. Leave me any feedback in the comments down below if you haven't done so already, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about another concept that is fundamental to the growth of your money and to your financial literacy, and that is the rule of 72. So tune in for that, and hopefully that can help you to really get your money growing at a fast rate and understand how your money can compound into the future. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.